Welcome to another Straight Up Tuesday tip. I am Eric Workman with Renovo Financial, here with Mark Ainley and Tom Shawcross.
A little flat.
Yeah, that was pretty
That was a little
flat. I would
flat,
have
like-
expected more from you.
I did too. After all the making fun of me, I thought you were going to come in hot there.
Yeah, for sure.
So we're recording a few of these today, though, listeners. We'll get a second chance.
We'll get a second chance.
All right, so let's start redeeming yourself right now. So, Workman, you've been on, there's got to be close to 10 episodes. We got probably another trophy coming out. But
Maybe I can get an 8th grade basketball trophy? Or
yeah, we finished in second in 8th grade. That was a good year.
Okay. Yeah,
So
I'll take it.
Yeah, we lost the Mary Seat of Wisdom. It still hurts. Let's talk DSCR. So we've had this question come up several times. We're going to package it all into a big jumbled question because we like to do that. What is DSCR? What does it stand for? Why should investors care? How is it calculated? And why is it so prevalent in today's lending environment? So giant loaded question, but let's start at the top. What is DSCR?
Sure. So DSCR is an acronym that stands for Debt Service Coverage Ratio. It used to just be a qualification point, like, oh, what's the DSCR on this particular loan? But these days, as the credit and the capital market has evolved for loans generated by companies like ours, our long-term rental loans have become kind of a product in and of themselves out in the greater capital world. So these days, you even have places like Guaranteed Rate that are doing DSCR loans. And really what that is it's basically a commercial style loan based mostly on the property's cash flow versus, say, an individual investor's debt to income ratio.
Yep. So let's calculate this now. And I think most people grasp that concept. Walk me through what is in that calculation, right? Because I think that's where people kind of get off the rails here because they're like, oh, what am I doing for reserves? What am I doing for this? Can you talk about how you guys calculate it? It's different with each bank, but maybe in a 2 to 4 instance and then a 5+. What goes into this formula and what are you looking for when someone says you need to be at a 1.2 DSCR? What does that mean for someone who hasn't gone through that process?
Yeah, for sure. So there's 2 different ways to calculate it. And it's a 1 to 4 calculation, and then it's a 5+ calculation. And then inside of 1 to 4, at least for Renovo, there are different hurdles that you have to clear for each. So we'll start with the 1 to 4 calculation. The 1 to 4 calculation we refer to as the PIDIA coverage, and PIDIA is principal, interest, taxes, insurance, and then any association dues. So what you do is you accumulate all those expenses again. So it's principal, interest, taxes, insurance, and association dues. You take that total and you take your rent amount and you divide your rent by your PIDIA. And that should give you your 1 to 4 coverage ratio. So for us, when it comes to a single family home, we're able to approve someone as low as a 1.0 debt coverage on that.
That's
So
aggressive.
It's aggressive. Yeah, I'm sure it's aggressive. What you see, though, is you tend to see on single family homes that the expenses stay relatively fixed over the course of time. Obviously, taxes will go up a little bit, but you see more rent growth and more fixed expenses, especially on a single family home. So 1.0 is an approvable coverage level for single family homes. For the right type of borrower, if you're talking someone who's super experienced and has extraordinary credit and a ton of liquidity, we can maybe get close to that on something that's a 2 to 4 unit. But generally speaking, on a 2 to 4 unit, because the income should be so much higher, we're going to be at a 1.2. So you're going to want your rent to be 1.2 times higher than your principal, interest, taxes, insurance, and then any association dues.
Man, that's changed. So 15 years ago, or out of the crash, getting loans from the community banks, they're at 1.3 to 1.4 for and that was aggressive for them.
Well, also with reserves, with vacancy,
Yes.
This is just off of true hard costs.
Yes.
True hard costs. And now look, this is for again 1 to 4 properties, right? But the math changes quite a bit whenever you're looking at anything that's 5+ or really even anything that's mixed use. I should have given that caveat there that if it's 1 to 4 and it's mixed use, we're going to look at an NOI calculation as opposed to just a PIDIA calculation. So when you get to 5+, not only do lenders, whether it be someone like ourselves or a bank, but also appraisers are really kind of dive into what the NOI on a particular property is. And NOI stands for net operating income. And in some of our previous conversations, what I've been telling you about, calls from borrowers are, hey, what's the max LTV I can get? What's my max loan to value? And I used to just say, well, it's 75%, right? We can get to 75%. And that's when interest rates for us were in the 4s to 6s. These days, I say it doesn't really matter. Well, what do you mean it doesn't really matter? What's your max LTV? And what I tell borrowers these days is on a 5+ unit property, you have to tell me what the NOI is. If you tell me what the NOI is, then we can back into how much debt the property can carry. And then we'll see what LTV that debt number ends up being, right? So my max is still 75, but more and more these days we're seeing just where interest rates are, loans coming in between 66 and 70 generally. Is just what the NOI of the building will allow.
Yeah. So just to be clear, like you're running into your DSCR cap before ever hitting the LTV cap.
Absolutely.
Right.
Yeah, it's happening all the time.
Yep.
And so to kind of rewind a little bit and just give the borrowers the way that the NOI calculation is run, it's your rent less all of the operating expenses that a 5+ unit building could possibly incur. So you're going to have a vacancy factor, which typically isn't taken into account when you're looking at 1 to 4 unit properties. You have a vacancy factor, you have your property taxes, your insurance, you have property management fees for these greedy property managers that are out there in the marketplace. You have property management fees, you have repairs and maintenance assumptions, you have capital expenditure assumptions. Depending upon the size of the property, you'll also see things like legal and administrative and marketing expenses that'll get loaded into kind of the expense side of an income statement for a property. But all that leads down to NOI, which is net operating income. And when you calculate the debt coverage on a 5+ property, what you're looking at is your NOI divided by your debt service. So whether you are picking a loan that's amortizing, and so your debt service is principal and interest, or whether you're just picking an interest-only product, it's that NOI divided by whatever the debt service number is for the loan that you're choosing.
Got it. And right now, depending on personnel, but like you're still looking at like that 1.2, like that's probably a typical number.
On an amortizing loan for a 5+, if we're looking at 1.2. If someone chooses to go the interest-only route, it's 1.25.
Got it.
Yeah.
Makes sense.
What about with a portfolio? You kind of gave some building specific, but what if someone's got 2, 3 flats and 6 single family homes, kind of a portfolio style?
Yeah. So if it's a small portfolio, so if it's under 10 properties, we look at it like it's a 1 to 4 unit.
Okay.
So we look at it on a PIDIA basis. If it's a large portfolio, it's looked at like it's a 10 unit building, and we do it based on a NOI.
Cool. Rent calculations. So let's say, you're doing a rehab, you're projecting rents are going to be this, or like, you've taken over and you've inherited some low rents that are going to go up, whether because you're going to get your tenants in there, you're going to have that conversation about renewal. How are you accounting for that? Right? Like, do you have to go off the number on the spreadsheet? Do you have to wait till we have renters in the building? Like, that's as an operator and as someone who does rehabs, that's like one of the harder pieces of the puzzle is getting everything aligned.
Sure.
To get the financing, because you're sitting there paying private money, hard money, et cetera, wanting to get into this fixed loan as quickly as possible. Yeah.
So great question. And we're seeing it quite a bit that somebody will be getting a really good deal on a building because they are, someone's owned it for 15 years. Maybe some of the tenants are even 15 years old. So they've been in there for 15 years, not 15-year-old tenants. But they just the in-place rents are quite a bit below market, right? And so if they were to purchase the property with a DSCR loan, we would have to use what is in place. And so for a lot of our borrowers, they're buying them on bridge loans, which our bridge loans have no prepayment penalty. They're buying them on bridge loans. they're doing light renovation to the units or to the building itself, and then they're turning that rent roll over, or at least getting it up to market rents, and then refinancing based off of the new rent roll as opposed to what was existing.
Got it. So that's your workaround to get to a stabilized position.
That's right. Yep.
Cool. Anything else on DSCR?
It's been around forever, though, right? Like it's like I've known it for the last 15 years, but it just seems to be so much more prevalent these days. Is there? And you're saying now conventional lenders are using it as well too. Like why is it being used more, or why is it being approached? It's just more capital to be lent out, and they're finding fancier ways to do it.
Yeah. Well, when you and I first met each other and we were getting started in this business, there wasn't a place for an investor to go get a loan on a single family rental property, right? I mean,
Yeah.
other than a small local community bank.
Which at that time you can only get four. You can only get 4 loans conventionally back then. Investment properties.
Sure, and then
had
they
to go further.
expanded it up to 10,
Yeah.
right? Or sorry, 9 plus your personal, but you had to make a lot of money
Yeah.
It all hits your DTI.
because it all hits your DTI, right? A lot of times they'll give you 75%, at least 10 years ago. The conventional underwriting for having multiple rental properties was they'd give you 75% of the rent as far as income credit, but they charged you 100% of the expenses as it relates to your DTI. So
6
you had
months seasoning too, right?
6 months seasoning. I mean, there were all these hurdles that you had to clear. You had to have a significant W-2. And then you also had to have, and this is where a lot of investors got tripped up, is they couldn't take advantage of all of the write-offs that come along with owning real estate, because then your taxable income gets diminished significantly. And then the conventional lender says, well, I understand your top line is high, but your bottom line is low, and I have to lend off of your bottom line. And it just wasn't out there. And it was probably 9 years ago, that some enterprising capital sources for the investor market started to really take a look at, there's a huge demand for it out there. I think, these days still 1 in every 5 or 1 in every 5.5 single family homes in the United States is owned by not even by a big investor, but by a small, mom and pop style investor. And when you have that many assets that are out there that are in need of debt, capital tends to find its place. So it's an industry that has grown. It's a product that has grown. It's become securitizable at this point. It's performed well, generally speaking, as it relates to, other securitized debt. And I don't think it's going anywhere.
So
If anything,
market demand is the answer there.
typically is, right?
Yep. All right.
Good
Awesome.
stuff. I'm pulling up my Chicago fact here.
All right.
Sponsored by Renovo, but who we playing for?
All right. We're playing for Craig Lambrola.
I saw you look it up there.
I had to look it up. So Craig Lambrola, he bought something on the Straight Up Chicago Investor merch store. So
I just bought a new quarter zip, so we're gonna play for me at some point.
your name went in the hat. I saw it the other day.
All right. So our friend here, Eric, is from Naperville. So I got a Naperville related question.
All right.
Riverwalk there is fantastic. What downtown Naperville is known for. In what year did they start construction on the Riverwalk in Naperville? And your options are 1969, 1981, 1990, 1999. 69, 81, 90, or 99. When did they start construction on the Riverwalk?
I would say 90.
I think it's 99.
81, boys.
Oh, man. I knew
boy,
it
they
was
must have
99
got-
because I used to
It's
think
way
girls
off.
on dates are like in 98, 99. Like, that was like a high school date, like growing up in Addison. Like,
You should have thrown that out there. No, sorry, Craig. Yeah, that was.
Craig. What is it, 81?
81.
Man, you threw out the answer too quick. Like, you didn't give us time enough to strategize. Like,
You guys made your choice.
I could have talked him out of that. Like, yeah, I could have.
You could have talked me out of
Yeah,
99
yeah,
for sure
well,
if you would have
man.
said.
What if that was the
By
right
the
answer?
way, in
I think
98.
you wanted Craig to lose. I think that's part of the
I
problem.
don't like. I've never liked Craig.
Well, now Craig can play again. He just has to buy one more piece
I
of
hope
merch.
Craig's at our event then.
Craig, you don't have to buy something else. We're going to put your name back in the hat. And when I draw Tom's name, I'll pull your name as well, too, just in case. So, all right, Eric, thanks for coming on numerous times here. This is awesome. Tom, thanks always. Listeners,
Of course.
you can also be part of the Chicago Fact. Go to straightupchicagoinvestor.com. Go to the merch store. You can buy anything from baby bibs to you could buy shoes with Tom's face on it.
I don't know why those are there.
But also you can just buy a cool tri-blend t-shirt. So thank you, Eric. Thank you, Tom. Listeners, we'll see you next week.